It's a panic move. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the government just did the unthinkable, and I want to understand why this is so frightening, because they're doing everything they can to prevent an all-out currency crisis that will plunge the entire global economy into a recession. But as you're about to see, nothing they're doing is working. Now let's head over to Bloomberg. We picked today's story up, and we're going to go back to last month now, as the yen's relentless drop showcases the Fed's grip on the global markets as the Japanese currency touched a 38-year low as the dollar climbed higher. And what this is threatening to do is kick off a global currency crisis. Now, we've seen this happen in the past, and when it does, well, it usually roils equity markets and plunges major economies into an immediate recession. It's a realization shared by global investors as they parse the way to still high U.S. borrowing costs that are buoying the dollar and the impact that has on the rest of the world. And the $7.5 trillion a day market for global currencies, the yen's relentless rout offers an extreme manifestation of U.S. financial dominance. And I want you to get the picture here that everybody believes the story is about the dollar, as I'm going to show you, and it's absolutely nothing to do with the dollar. The problem that's going on in Japan is really a sign of what the problems are in the entire global economy. It's all about the Fed. Higher for longer is keeping the front end of rates very high and drawing money into the U.S. and keeping the dollar strong. And here you can see there's some evidence to support that, but not a lot. As we look at the federal funds rate in blue, and we're looking at the Japanese yen to the US dollar spot exchange rate, and I've inverted that to show you how the yen is trading. And here you can see that it is indeed trading at very low levels, and that dotted green line showing that it's lower than it's been on our chart since the early 1980s. And what's happened here is the belief is that as the Fed raises rates, money flows out of Japan into dollars and into U.S. treasuries, and that means, of course, you see a weaker Japanese yen. And there is some evidence to support that as we look at here in the mid-80s, and then again we look at the mid-90s. A rising federal funds rate did eventually lead to a weaker yen, but it wasn't an instantaneous response. We see the same effect happen in the late 1990s, and again, you look at 2004, the Fed dramatically raised rates, and yet the yen did not fall that much. In fact, even in 2016 through 2019, the Fed raised rates and had virtually no impact on the yen. But this time, it's having an outsized impact on the currency, threatening to plunge Japan into a complete currency crisis that would drag Asia down with it, lead to a banking crisis, and pull the rest of the world down with it. And this is causing the Japanese governments to do unthinkable moves that are having absolutely no effect. The problem is they don't understand what's going on, and neither do the experts. The problem is efforts by officials in Tokyo to prop up the yen so far have fallen flat. The Japanese currency has continued to weaken in the week since the Asian nation's record $9.8 trillion, more than 60 US billion, foray into the foreign exchange markets, and further intervention is likely to be ineffective. And that's the problem, is Japan is intervening in the markets in a big way. They're not being effective. And if you want to be effective and make money on the markets, well, let me show you how to do that. As of close of July 12th, our CTA Time Report, get this, going into the weekend, could you imagine looking at your brokerage account and seeing every trade on the book in the green? Or how about our Momentum Time Report? We've got 21 open trades, 19 of them are up. That is a 90% win rate going into the weekend. Do you know how hard that is to achieve? It's because we give our subscribers better data. When we talk about our CTA Time Report, we look at machine positioning. We find these deep short positions that when price of a security rallies against it, our report flags that as a potential trade. Maybe you like to trade the technicals like the RSI and the MACD, but you find yourself getting in late, getting out early, and just not making the returns you want. We look for big pullbacks and momentum, and when our report flags a change in that, it gives us a signal. And here's here's the best part. I review every trade and give you my opinion on which ones you should do. You get the daily report. You get the tradable signals. You get stop loss levels. We track the trades and the returns for you. And every weekend, we give you an update on the stop loss levels of where you should be. And here's the best part. You want to make outsized returns trading. You want to brag to your friends that you've got these huge trades and that you're making money trading. Here's the best part. You can do it for 30 days for free. That's how confident we are, because if you would have signed up 30 days ago, you'd be seeing some impressive results on your trade screen. And I don't see any of this working until the Fed actually eases. Well, maybe they should sign up for our reports, because that is working for our subscribers. The big picture is you have to look at the links in the description below to jump on that 30-day free trial, because you have to get the demand for dollars lower in Japan. You either get your long end rates high enough or you get US rates low enough. Neither of that is happening. And that's the belief here, is the problem with the yen has to do with the discrepancy in interest rate policy, and that is not the actual truth. What's going on with the yen is indicating there are serious problems in not just the global economy, but specifically Japan and all throughout Asia. And the problem with that is it spreads into Europe and eventually over to the US, and currency issues have major havoc on banking systems. And if you really want to understand what's going on with the yen, well, you don't have to look at the Fed, as everyone thinks is the issue, even as, of course, government officials in Japan believe is a problem. It has everything to do with the demand for dollars. And what happens is when demand in the global economy falls, you see here shown in imports of goods and services in blue on a year-over-year rate of change, as that slows down and contracts when it's shown underneath that horizontal black line, demand for currencies go down with it. So what you notice here, it isn't an issue of the Fed, but it is an issue of global trade. And you can see here again in the late 90s, global trade decelerated. This is showing again imports into the United States. Of course, demand for the yen went down. You see it happen again here in the mid 90s. Again during the dot-com bubble. How about going into about 2012 through 2015? What happens? The yen goes down because demand from the economy is going down. And right now, what we're seeing is while imports into the US are roughly neutral, you see here right on that black line, what the yen is suggesting is that things are actually far worse than the data here is showing. And at some point with a lag, this is all going to catch up, and it's indicating that possibly Japan could be at the epicenter of a global currency crisis, and this is why the elites in Japan are pulling out all the stops to try to keep the currency from falling even more. And asset managers have been piling into bets against the yen, and last week were the most bearish in data going back to 2006. And of course, the issue here is everyone believes it has everything to do with speculators betting on a weaker currency, and what they're actually doing is betting on a weaker economy and betting on the fact that interventions by the Japanese government will remain ineffective, and they've got that bet right. And a lot of stake is for Japan, as Citigroup estimates the country has 200 to 300 billion of ammunition to fund any further invention campaign. And this would entail selling dollars and other currencies it holds in cash reserves, or even, and this is the big one that everyone's concerned about, government bonds around the world to buy yen as they look to do anything to keep their currency from collapsing. Because the risk that the central bankers see in Japan is a weaker currency will lead to inflation, but it doesn't always do that. What you're seeing here is a weaker currency is telling you that global demand is about to plunge off the cliff along with the global economy. Of course, we have some evidence that while everyone believes that if Japan starts selling treasuries, it's going to send interest rates higher, the actual opposite would happen. And this is just a point that when you think about global demand and you want to increase it, well, you need to increase trade. And how do you increase trade? Well, you get consumers to buy things. And if interest rates are too high, they don't buy. But if they go down, well, they might. And here you can see 2-year treasury shown in blue against the Japanese yen to US dollar spot rate. Again, showing the spot rate inverted so we can see how it looks from the yen's perspective. And what do we know? That periods where the yen actually declines in value, look what happens to 2-year treasuries. They go down, not up. And the prevailing view here is that, again, Japan will be forced to sell US treasuries to prop up its currency, sending US rates even higher. But in actuality, what it is telling us is the global economy is in a dangerous situation, and the only way to revive it will be through lower interest rates. Again, you see that here in the mid-90s. You look to, of course, the dot-com bubble, and you see the same effect every time the yields are coming down. Now, they didn't happen here when the Fed had rates pinned at zero, but look what's happening now. The yen is predicting a huge and massive decline in U.S. Treasury yields. Again, you want to create dollars, you want to create demand for currencies, you need to get consumption up. And right now, interest rate policy around the world is too high and is constricting the creation of credit, is constricting demand, and that's leading to the Japanese yen all out in a free fall. And of course, now the government in Japan did the unthinkable. As we looked here, now moving up a couple days from now, as foreign use of the Fed tool hits a record amid Japan intervention talks, as cash stashed at foreign reverse repo climbed to $399 billion. And look at this. The foreign reserve repo pool, like the domestic reserve repo, is a place where counterparties can park cash overnight with the Fed. Monetary authority such as the Bank of Japan can keep big chunks of funds that are earning interest of its treasury bills and other securities. And when they need to do something with those dollars, well, they can just withdraw it from the facility without ruffling markets. So rather than invest in treasuries, what you're seeing here is Japan park cash at the Fed. And this is like loading a bullet in a gun, of course, a monetary gun, and making a big threat at the market, saying, look, we've got this money piled up, we're ready to intervene. And everybody realizes that. Now, the issue here is, of course, Japanese government thinks this all an issue of speculators. They don't realize that their economy is teetering on the brink of an all-out collapse. The yen rapidly soared more than 2% against the dollar after a softer than expected reading of U.S. inflation on Thursday, prompting speculation that Japan stepped into the market to support its currency. Of course, that was brought up by the fact that they had that big cash pile ready to go. And the nation's top currency official said he wasn't in a position to say if the move was an intervention. Of course, they never will. He said that authorities would disclose an intervention at month end if one indeed occurred. And Japan has acknowledged it spent $9.8 trillion or $61.3 billion intervening in the currency markets between April 26th and May 29th. Although specific dates weren't disclosed, trading patterns suggest major interventions occurred on April 29th and May 1st. Data on foreign reserves suggests Japan sold treasuries to fund these actions, and despite that, what happened? Interest rates went down because, what's happening in Japan is a sign for the entire global economy that something serious is wrong here. And the fact that Japan is intervening in its currency markets and it's having no effect is just a sign of how weak the Asian economy is. And here we can see Japan intervenes in the foreign currency markets to crush the shorts. And what we know is they did intervene in the Forex market. This is according to Japanese TV, citing government sources. And this is just the first of many moves. This was followed by a flurry of comments from the recently fired Japanese top currency diplomat. And here he says, we generally don't comment on whether we intervene. And we didn't intervene today. Well, we'll disclose that at the month end if we did, as fluctuations are large and differ from fundamentals. And that's the issue here. They actually believe that this is not a fundamental issue with their currency, when in fact it is, because their fear is big currency moves have big impact on people's livelihoods, as the belief that a weaker yen will lead to massive amounts of inflation, force, of course, the Bank of Japan to tighten monetary policy even further to contain it. And then in the end of the day, you get an all-out recession because policy is too tight. But here's the problem. If their currency crashes, they get a recession anyways. And that's the bottom line. No matter what the government does to have the same outcome, they just believe that they can manipulate it. And what this also means is Japan finally cares about the explosive inflation yen collapse has sparked, even though it hasn't sparked much of one, and often happens is speculators get the blame. And here you see Japan saying it said speculation is controlling the markets. And again, recent moves are not reflecting fundamentals, but as I showed you, they are. And what we can note here is that the consumer price index, now we're going to look at US data against the yen to dollar spot exchange rate. And what you can see is when, of course, the yen declines in value, showing here the dollar increasing against the yen, it leads to further disinflationary forces. This is actually putting a chokehold on the U.S. economy. And what we can note is it shows up during times where we either face a soft landing, potentially even an early recession signal. But in more modern times, what happens? It preceded the dot-com bubble. It preceded the global financial crisis. We almost had, of course, a global recession in 2015. And what happened? The dollar against the yen rallied. U.S. inflation and demand came down. Now, of course, we still hear from Fed Chair Jerome Powell that inflation is not going to come down, at least as fast as they expect. And on July, we'll hear later this month that they need to keep policy strong. Well, at the rate the dollar is rising against the yen, we note that inflation in the U.S. is coming down. But does that mean that we'll see inflation in Japan? Well, prices may go up there, but keep in mind, if consumers can't afford them, then guess what? They'll get rejected, and you'll see, of course, the Japanese economy spiral into a recession. And that's why, of course, they intervened once again, because the first time wasn't enough, the second time wasn't enough. And here you see they spent 22 billion on yen intervention. This was again on Thursday, as a suspected intervention with the first aimed at boosting the yen when it was strengthening against the dollar. A fresh development in Japan's strategy of trying to keep speculators on the back foot since it started propping up the yen in September of 2022. And keep in mind, this is the same issue we heard out of China. Of course, the yuan was falling. They blamed speculators. The government says we could just flush them out. Everything will go back to normal. But this is a fundamental issue. The reason the yuan is plummeting, the reason the yen is plummeting, is because global demand in Asia is coming on the edge of a cliff and is about to crash. And this is just a sign of what's coming to the rest of the world. Official monthly intervention data is due July 31st, when Canada is scheduled to step down. And get that, why would you make these moves? Well, you do it before you're forced to step down as part of a regular bureaucratic reshuffle to be replaced by the person who's currently the Director General of the Finance Ministry's International Bureau. And Japan's government has struggled to shift the tide in the foreign exchange market. And that's the point. If it was merely just short sellers, then all of this would work. But the problem is, it is a fundamental issue, again, not just with the Japanese economy, not just with the Asian economy, but the overall global economy. Because if the U.S. economy was indeed booming and consumers here were demanding foreign-made goods and services, you would not see the yuan and yen plummeting in value, nor would you see interventions outright fail. And inflation stayed elevated or above the BOJ's 2% target for more than 2 years, with the yen being a key driver as real wages, that's inflation-adjusted wages, fall. Consumer spending has dropped every quarter for a year through March. And of course, we know what happens in the U.S. when that happens is inflation eventually comes down. Of course, the experts there believe it has everything to do with the currency. What it really has to do with the fact is that consumers cannot afford higher prices, and at some point, demand falls enough that prices go down too. And Japan's central bank has repeatedly said it does not target the yen and has shown resistance to overtly changing policy to support the currency. But we know that the governor said that the policy could be changed at the weekend, was seen as changing the outlook for inflation. Of course, they're completely afraid here that it is. And that's a dangerous sign here, because what we know is that it likely will have no effect on inflation at all, because demand is coming down. And that is the problem that every country around the world is facing here, is that these currencies are falling against the dollar. And yes, there's some argument that money is flowing into the U.S. because of the yield differential. But underneath all of that, the global economy is falling apart. And some of this may have everything to do with the safety trade. But here's one of the issues, is the BOJ is still haunted by its past mistakes of being forced to cut rates shortly after hiking, and they don't want to make that mistake again. But in reality here, that is exactly the problem, is that rates around the world are too high. It's constricting the creation of credit by inverting all the yield and money curves. It's leading to a decline in demand. And then what's going to happen is it's going to spark an all-out currency crisis. We could see, of course, the epicenter be Japan. And if it happens, watch, it will spread very rapidly throughout Asia and eventually the rest of the world, and end up plunging every major economy into a recession, if not all-out financial crisis. And I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.